In the last 2 weeks, mortgage rates went from the lowest levels in 3 years to 7-month highs. Central banks are now talking about rate hikes in Europe, and oil prices are driving the entire conversation. If you want to understand what is happening and what to watch for next week, you're in the right place. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Welcome to this week's Weekend Update. This is your weekly market intelligence report, and we put it together specifically for realtors, financial planners, and the professionals who serve them. Let's get into it. The big story this week was the Federal Reserve meeting on Wednesday. As expected, the Fed held rates unchanged. No surprise there. But what came out of the Fed Chair Jerome Powell's press conference was not what the bond market was hoping to hear. Powell acknowledged the war in Iran as a source of uncertainty. He downplayed the February jobs report, which showed a loss of 92,000 jobs, saying 1 month is not enough to draw conclusions. He also raised the Fed's inflation forecast, moving the core PCE estimate from 2.5% to 2.7% for this year. And while the dot plot still shows one possible rate cut later this year, the market came away from the meeting feeling less optimistic than it went in. Here's where things stand today. The 10-year Treasury is at 4.37%, up from 4.28% at last week's update. This is as of our recording this morning. The 30-year fixed is sitting at 6.43%, and the 15-year fixed is at 6.02%. Keep in mind, those are national averages and not a rate quote or an offer to lend. These are not the numbers we were looking at just a few weeks ago. At the end of February, 30-year rates were at their lowest point in more than 3 years. That changed fast. The Fed funds futures are now pricing in the next rate cut, pushed all the way out to April of 2027. A week ago, there was essentially zero chance of a rate hike at the next Fed meeting. As of today, markets are pricing in nearly a 10% chance of a hike. That is notable, a notable shift in sentiment, even if the probability is still relatively low. So, why did things change so quickly? One word: oil. An Israeli strike on a natural gas field in Iran triggered retaliation against the world's largest natural gas field in Qatar. Brent crude, which represents roughly 80% of the world's traded oil supply, moved above $110 per barrel. WTI is around $95. The spread between the two reached its widest level in over a decade. Central banks around the world are watching this closely. The European Bank is now telegraphing a potential rate hike at their April 29th and 30th meeting. The Bank of England has signaled they are standing ready as well. When European central banks start talking about hikes, that ripples through our bond market here at home. Fed Governor Chris Waller, who has been one of the more dovish Fed members, came out this week sounding more cautious. He said the Fed can usually look past oil price shocks, but this situation may be different if prices stay elevated. He does believe structural inflation is trending down, and he thinks about 0.5% of current inflation is tariff-related and temporary. But oil has him watching carefully. The bottom line for mortgage rates: war-driven oil inflation is keeping upward pressure on yields. Until there is resolution or at least stabilization in the Middle East, the bond market is going to stay defensive. Let's talk about housing for a minute. January new home sales came in at 587,000 on a seasonally adjusted annual rate. The consensus estimate was around 722,000, so this was a significant miss, down about 18% month over month. The media coverage was heavy on alarm bells. Here's the fuller picture. Just 2 months earlier, we saw a 17% move to the upside. When you look at the 3-month average through January and compare it to the 3 months before that, the numbers are nearly identical. 688,000 versus 692,000. That is not a collapse. It looks more like builders pulled some demand forward ahead of year end, and January reflected that. Month supply for new homes did rise to a 4-year high of 9.7, and median prices are down 6.8% year over year. Those are numbers to watch. If sales remain soft in February and March, the story may change. But 1 month does not make a trend, and that is a point worth making to your clients who are watching the headlines. February new home sales data comes out Tuesday, March 24th. That will be an important number to follow. Now, let me share a few things that are available on the dashboard. Either on the right side of the screen or below the video, depending on the device you are using, this week's featured tools and articles are designed specifically for the professionals in your network. First, the simple 3-part selling system that puts your home in front of 50,000 buyers. If you work with sellers who want to maximize exposure, this is worth a look. Second, your credit cards are either building your score or destroying it. Here's the fix. Credit is a conversation that comes up almost every transaction. This one is a useful resource to share with clients. Third, your home built the wealth. Does your family know how to keep it? This speaks directly to clients in the wealth preservation conversation, and that is a conversation financial professionals are having every day. And fourth, the 5 credit myths keeping you from the home and financial life, and the financial life you want. Share this with buyers who have questions or hesitations about their credit picture. We also have a couple of bonus resources this week. I recently attended a conference where Brian Buffini was the keynote speaker. I put together a detailed recap of his commentary, and I'm happy to share it with anyone who wants it. Just send an email to ron@ronsiegelradio.com, and I'll get that to you. And we have a 187-page AI Realtor Handbook available as well. If that is something you want, same thing. Send me an email at ron@ronsiegelradio.com. On the financial tools side, we have put together a suite of financial calculators for our partners, and they are complimentary. This week, we're highlighting the refinance calculator. Did you know there are 3 very specific calculations that determine the true break-even and benefit of a refinance? Most people only look at one of them. If you want access to the full calculator suite, just ask. Everything is available on the dashboard. Looking ahead to next week, here are the reports to watch. Monday brings January construction spending data. Tuesday is a big day. We get February new home sales, March S&P Global PMI readings for manufacturing, services, and the composite, and the Richmond Fed reports. New home sales will be closely watched after January's soft print. Wednesday brings durable goods and February import-export price data. We also get the weekly MBA mortgage application numbers, which will reflect how the rate environment is affecting buyer and refinance activity. Thursday gives us weekly jobless claims and the Kansas City Fed Manufacturing Index. And Friday wraps up the week with the University of Michigan Consumer Sentiment final reading from March and the 1-year and 5-year inflation expectation numbers. With everything happening around oil and inflation, these consumer expectation figures could move markets. Remember, strategy beats rate always. That is the foundation of every conversation we have, and it matters even more in a market that is moving this quickly. We appreciate you taking the time to be here and listen today. Have a great weekend, and we'll speak to you again next week.